U.S. gross domestic product rose 2% in the third quarter, up from 1.7% in the second quarter. But as we asked before the break, is that progress? We asked for the answer from Ward McCarthy. He's chief financial economist at Jefferies Company. He is a Bloomberg best economist, and that means he is one of the most accurate forecasters in the world when it comes to GDP. Ward, thanks for joining us.
My pleasure.
This was bang in line, really, with estimates, 2%. But we did have some seemingly positive news, and that was that at least household purchases rose at 2.6%, a little bit better than expected, and the best quarter, really, of the recovery since it began in June of 2009.
Well, I think it was, a sigh of relief number. There was some concern that the economy may turn down because of some of the problems we had towards the middle of the year. And I think what we learned today was that we have weathered the soft patch and that we are seeing a rotation in some sectors of the economy that we need to see in order for the economy to continue to grow, which I expect it will.
So we're out of the woods completely?
Well, I don't know what you mean by the woods. I think it's going to be a long period of time.
To potentially a recession at this point, which is still out there for some.
I don't think we'll go back into another recession.
But will it be slow enough growth that it'll feel like a recession?
Well, it still feels like a recession because we lost so many jobs in the prior recession. Quite frankly, when you look at this recovery and compare it to the prior two, we've actually done relatively well, both in terms of GDP growth and also in terms of the timing of when we started to generate job growth again. The problem is that the recession was so severe that even though things are improving, we still have 7.5 million people out there who lost jobs who are still waiting for a job to come along.
And we should point out that polls that have been done, they say even though things kind of have gotten better, people don't feel like it at all. And maybe it's because of how bad it was.
If you don't have a job, you still don't feel better. That's right.
Of course. Let me ask you about the Bush tax cuts. There is more concern from economists that they will not be extended. Do you think it matters? I mean, if we don't get any of the Bush tax cuts extended, is it really an economic catastrophe next year, as Art Laffer told us yesterday?
Well, I think it would be a very significant policy mistake if Congress were allowed the tax cuts to lapse, because the economy, as Carol pointed out, is moving in the right direction, but it's still fragile. And were we to impose a significant tax increase on U.S. consumers, consumer spending, which is just slowly recovering, would go in the opposite direction, and that could cause a serious downturn in the economy, in my opinion.
We get a read on jobs next week. I mean, is that kind of your next focal point, or you're kind of looking at next week and I'm like, where do I focus? Because you've got the Fed meeting, you've got elections, you've got non-farm payrolls.
A lot to talk about next week.
Next week promises to be very interesting. I think the primary focus, at least of the bond market next week, will initially be the FOMC meeting, and that's probably going to have a dominant effect on the bond market for some time to come. But looking through that, that'll become the next important factor for the bond market, and I think what we'll find is that we're continuing to generate private sector jobs. We'll lose some government jobs, both census and also at the state and local level. And I think we'll have one more month at 9.6% on the unemployment rate before we start to see the unemployment rate start to trickle down.
What about quantitative easing? I mean, beyond the bond market, should we all also be watching this? Is it going to have any effect on the real economy?
Well, I'm less inclined to think it will have a near-term effect on the real economy than I am to think that it will have an effect on some of the other markets. For example, Jefferies, we're optimistic about some of the risk asset markets. But I think the primary objective of the Fed in imposing a QE really is to make a statement that they're trying to preempt a deflation from occurring. We have had a disinflationary trend for a number of months.
At all cost.
And it would seem that maybe almost all costs, yes, I would agree. So we'll find out just how far they're willing to go on Wednesday. And I think it will have to be a compromise decision, because while there are some Fed officials who are all cost, there are others who are more cautious. So I think that will limit what they do.
All right, we got to run. Hey, Ward, thank you so much. Ward McCarthy over at Jefferies Company.